With us now on Voices of Wall Street is Liz Ann Sonders. She's the Chief Investment Strategist at Charles Schwab. Liz Ann, it's always great to see you. Thanks for being here.
My pleasure. Thanks for having me. Looking forward to it.
Well, optimism is pretty abundant this week, and it's fueled by Fed Chair Jerome Powell's recent comments that they are committed to supporting the economy and that they will, of course, continue to have an aggressive plan to reopen and also to try to help those who have lost their jobs. But the exuberance that we're seeing in the markets, is it warranted, do you think?
So, to some degree, but I think there's so much good news that's priced in. I do think there is some sentiment related risk, either as a function of it really could be one of two things happening. I think weaker than expected economic recovery in the kind of post-vaccine timeframe, whenever that is, which would obviously be a negative from a market perspective, especially given how much good news is priced in. And then, of course, the other side of the coin would be an economy that overheats and inflation picks up maybe to a degree beyond what the consensus is built into expectations and elicits fears of will the Fed have to start to tighten policy or are financial conditions sort of tightening on their own. So I do think that those are representative risks. The good news is that a lot of the real speculative fervor in the market that is of concern is in small pockets of the market. It's not akin to what we saw, say, in the 1999-2000 period. So I would make that distinction.
When it comes to the labor market, as I mentioned, the real unemployment rate in the country right now is closer to 10%. You've emphasized that this recovery could also be a key factor for monitoring inflation. Talk to me about how they actually tie in together.
So I actually don't think we have much risk of a true systemic inflation problem, akin to, say, something like the mid to late 70s into the early 1980s. And that was of the wage price spiral variety. And it does tie into the labor market. And when you have as much slack as we have in the labor market right now, I agree that sort of the real unemployment rate is probably closer to 10%. You've got what has been a surge in permanent job losses relative to temporary unemployment. About close to 40% of those that are unemployed are what's considered long-term unemployed, so more than 27 weeks. And with that much labor market slack, not to mention global economic slack, it's still a big difference between where economic growth is now and potential GDP, that doesn't tend to breed an inflation problem. That doesn't mean we're not going to have price shocks, supply demand related price shocks as things open up a bit more. You can have those imbalances driven by just that mismatch of maybe surging demand in the short term and the inability to get that supply to match it. And then I think inflation, just based on simple math, when we were during the worst part of the lockdown phase last spring, most traditional inflation metrics basically went down to nothing. And in some cases, you went into deflation territory. So given that a lot of inflation metrics are looked at on a year over year basis, we're running into that period where the comps, as they say, are going to be really easy. So you're going to see some percentage jumps that might be a bit unsettling. But I think what we'll hear from the Fed is they'll emphasize the math associated with that and the fact that a lot of these things are transitory and not something we should extrapolate too far into the future. And then the velocity of money is basically been on the floor. So we've seen a surge in money supply, but we're not seeing velocity, whether that money's kind of getting out into the economy and picking up speed. So those would be the factors down the road to keep an eye on for that potential risk of systemic inflation. We just don't think it's a near-term issue.
And I think it's important that you mentioned that there are going to be sort of these shocks, but that overall, because the shocks are related back to just the time period of comparison, that's kind of where it's coming from. Jerome Powell has also reiterated multiple times now over the past year he's concerned about the unequal distribution of the job losses in the recovery, that some of those jobs that have been lost may never come back, and he is very focused on trying to help those cases. What do you see as being sort of the key tools for the Fed to be able to do this?
I think the tools from a job growth perspective and trying to make sure that we're stimulating industries and sectors looking ahead that will be job growth drivers. And it may not be the same industries and sectors that were some of the biggest job growth drivers in the most recent period of time. We know that services in terms of percent of GDP has never been, or consumption of services as a percent of GDP has not been a big economic driver to the same degree that the sort of the good side of the economy has been. But it was an ample place where jobs were created in this last economy. We know that's not likely to be the case, but there are even larger industries, larger swaths of the economy that will be job creators. What I'd like to see beyond just things like fiscal relief in the near term are both monetary and fiscal efforts to and private sector efforts to bridge that gap via skills training and education so that we can find a place for what may be longer term displaced workers in many of the growth industries. One good piece of news on that is that when we had the housing bubble and subsequent bust, a lot of employees from that broader industry sector ended up going into leisure, hospitality, retail. The good news is that it's a part of the economy that's a booming again, and hopefully we can see some labor absorption there. But we're going to have fits and starts along the way.
Speaking of sectors, you've been looking at some of these in more detail. Retail sales, for example, going after that V shape. We talk about shapes a lot now when we're looking at these graphs. It's another metric that you're watching closely because of what we just talked about, what you just talked about, some of the jobs kind of ebbing and flowing. So why is the retail sector specifically a very key indicator for you?
Well, it's really the only major economic data point. We get retail sales on a monthly basis that has had not just a V-shaped recovery, but we're well above pre-pandemic levels. But you have to peel back the onion a little bit, and it gives a better, I think, flavor and sense of the unique nature of this crisis. Retail sales as an economic metric is heavily goods based. There's really only one of the dozen categories of retail sales that's on the services side, which is food services. And even if you just exclude that, you see big differences with food services included, excluded. If you look outside of just retail sales more broadly at consumption of durable goods versus everything services related, you just see an unbelievable dichotomy. What I think that calls into question is the whole notion of pent up demand for two very important reasons. I don't disagree that it's a concept that is usually for economic good when you come out of a recession. I just think there's a double problem right now. First of all, we can't assume that there's pent up demand on the good side of the economy because we're at above pre-pandemic levels. So whether it's housing related, electronics, autos, there's nothing pent up. We've met that demand. And in fact, consumption there is starting to roll over a little bit. So we may have actually already exhausted a decent amount of that demand. There is ample pent up demand on the services side, but the nature of that is a bit different. If you know, if my hair has never been longer, and some of it is just I haven't had time. But let's say it's long because I missed what would have been 4 haircuts in the last year because my salon was closed. When it opens up, I go in, I get a haircut. I don't get four. If I missed 80 restaurant reservations in the last year and all the restaurants are open back up and I feel comfortable going back up, I'm not going to say, all right, I got to make up for 80. So I'm going out for breakfast, brunch, lunch, tea, dinner, and dessert. You don't say, okay, I missed 3 vacations last year. I'm going to take 3 all in a row, call your boss and say, all right, I'll see you in 2 months. So the nature of pent up demand on the services side is just a bit different. And I just fear there's too much optimism associated with that concept, and there may be too much extrapolating of pent up demand on the services side. When we get the initial pops that we're going to see, I would just be careful about extrapolating those gains well into the future.
I love those examples that you provided. I anecdotally have heard some of these retail, analysts or even buyers at some level of some of these retail stores see the direct impact of a fiscal event, right? I mean, when those checks went out, there were sales that day basically that showed exactly where that money was going. And so I think when you talk about services in the way that you did, I think that is something that most people should probably pay more attention to because, to your point, we're not going to we're not going to make up for lost time by trying to relive the past, missed appointments or
Right.
reservations. So thank
And
you for bringing.
once the current fiscal relief package that's being negotiated in Congress right now gets out there and the money is in the hands of individuals and families that are going to receive it as well as businesses, that's pretty much it on the fiscal side. And to your point, we had two record-breaking months for retail sales on several of the sub metrics associated with it. Both were the month of receipt of stimulus checks. And then it kind of rolled over thereafter. And again, we have another one coming that'll be larger than what was put in place in December. But they're pops. It's not necessarily sustainable. And I think the big open question when we think longer term is we know the savings rate has been boosted by all of this fiscal relief, and the real optimistic case says, well, the savings rates being historically high, if it goes back down to say long-term average levels, that represent, X billions or trillions of dollars of potential consumption. What we don't know is whether the COVID era unleashed maybe a period of greater frugality and a desire to maintain a savings cushion that is a bit loftier than what was the case last time. I'm not saying I think the answer definitely is yes. I just think we don't know what the longer term ramifications are of the weight of this crisis and how it. We know that coming out of the financial crisis, which was a housing debt bubble that really hit households more than anything else, that unleashed a decade-long era of deleveraging. So we may have to think about maybe a next era of, again, a bit more frugality and a higher savings rate.
I think your points about, again, the time frame and comparing one time frame to another year over year, that's also going to throw some people off. And then, I think oftentimes when we talk about some of the trends, people forget that the time parameters are so important when discussing certain types of trends. I mean, if you look at, one activity or behavior over a short period of time, that is a very different story than a behavior that might extend on a longer period. So I think to
Absolutely.
your point, the frugality might be this longer term story. The short term bursts, if we see them, after many people get vaccinated and things start opening up, might be a very short term pop. But, to your point, I love when you say that it's not appropriate to really extrapolate that
Right.
across a bigger narrative. Going back to inflation a little bit, and also on this very hot topic right now, Bitcoin. Tesla making an announcement in the last couple of weeks saying that they would invest more in that and maybe even start accepting it as payments. We've talked about Bitcoin on Voices of Wall Street in terms of just the valuation. Now, over $1 trillion in market cap. The new Treasury Secretary was asked this week even about when the the federal government might need to step in and look at this more closely and pay attention. What's your take on the impact that Bitcoin has had overall in the investing world, but also in terms of the way that companies might be running and even as an inflation hedge?
So I think that first of all, I was very much in agreement with what Secretary Yellen said broadly about cryptocurrencies and Bitcoin in particular. We are so far from it being anything resembling what we think of as a currency right now. It is just it really can't be used in any kind of broad way as a payment mechanism, notwithstanding what Tesla said about using it to pay. There's no oversight. There's no backing. There are tax implications. A lot of people don't realize that. Let's say you decide you're going to buy a Tesla with Bitcoin, you're basically selling Bitcoin in order to use it to purchase. That incurs a capital gains tax, and that's very different than if I use a credit card or write a check for a car. We know that where it's often used in terms of transactions is in sort of the dark corners of the black market, and I just think we have a long way to go. From an accounting perspective, I think there will be other companies like Tesla that decide to sort of add it to their balance sheet. I think that's going to be the exception, not the rule. If the price continues to appreciate because of how it's classified as an asset, you can't write it up, but you have to write it down as the price goes down, and the volatility is so extreme. I think that for investors thinking about it, even if the technology of blockchain and Bitcoin itself is with us, that doesn't mean there isn't a bubble in speculative fervor and volatility and valuation. I mean, the internet represented a massive bubble. The internet wasn't a problem. The internet's still with us, but we got sort of into silly season. So I would just be mindful of that. And then a lot of people don't realize that Gary Gensler, the new head of the SEC, is a cryptocurrency expert. He's taught college classes on it. Um, he is right now, most of the focus is on what the SEC might do with regard to the whole GameStop saga. But I think also top on the plate is the regulatory environment around cryptocurrencies. So I think the landscape has the potential to significantly change by virtue of the SEC. And again, it's not this long learning curve for Gary Gensler. He happens to be an expert in this space in particular.
Secretary Yellen seemed a little bit more open to the idea, or at least she confirmed that, the Fed was actually looking into more sort of digital currency, maybe a digital dollar. Lots of the central banks around the world are looking into this, and one factor is the accessibility of folks to actually get into the financial markets or into banking in general. Do you find that to be maybe a compelling case to, especially again, help along with this
I mean,
recovery?
I think the digitization of financial services is something that's on fire right now. I'm not sure that that in and of itself is some imminent support for cryptocurrencies. I think that's a much broader story, and we're seeing that as part of democratization and access for individuals, whether it's banking, whether it's payment systems, whether it's investing. And I just think that that is a separate story from cryptocurrencies, even if that now and eventually might be a component part, but it's not the biggest part of the digitization of finance and banking.
Fair enough, fair enough. And just finally here, looking after this time period of the recovery, what do you think the longer term sort of scars might be on the economy overall?
So right now, where we're seeing most of the scarring, we already touched on, it's in the labor market, it's long-term unemployment, it's permanent job losses. I'd say the one hopefully positive caveat with regard to long-term unemployment, which tends to be the most dominant scar from some of these severe crises-based recessions, that I think the stigma associated with long-term unemployment is dramatically lessened in this environment. One example would be if you're a Broadway actor and you've been out of work for more than 27 weeks, I really don't think anyone is holding that against you as sort of a personal sign of being unemployable. There's the skills gap issue that I think is important. But the good news is, even pre-pandemic, we were rethinking how you train and educate people. And I think this will continue and maybe has been sped up by virtue of COVID, rethinking education and how we provide it for the skills of where jobs are going to be most available, and a lot being done on the private sector with internship and apprenticeship programs that they're figuring out how to be accredited and what community colleges are doing. And I think we're going to get even more of that, because I think the shift we're likely to see in the economy is away from short-term discretionary consumption, consumer spending, and more toward a long-term investment-driven economy in infrastructure, which I think will be some combination of public and private combination. We're seeing how much money has been invested in the healthcare side, specifically for vaccines, but I think that's unleashed a healthcare investment cycle, education, infrastructure, transportation, et cetera, residential investment, housing. And I think that that is a healthier backdrop for an economy long term than one that had gotten heavily services oriented, heavily consumer spending oriented, with jobs that were on the much lower end of the income spectrum. Again, that's not a speedboat turning, it's an ocean liner turning, but I think that's the next shift we're likely to see in the economy. And I think that that is one that should provide a bit of a positive outlook beyond just the near term.
Lizanne, I love hearing all of the ways that we can look at this from a positive perspective, or at least look at the things that could come out of this positively, especially when it comes to, the confidence of those who are looking for jobs. I mean, we talked about how unemployment is really closer to 10% because people have dropped out. And I think maybe hearing what you just said, that the stigma around long-term unemployment may be gone, could really boost the confidence of those to come back into the workforce, or at least to look for jobs.
Absolutely.
Liz Ann Sonders, it's always a pleasure. Thank you so much
Thank
for
you.
spending
My
time with
pleasure.
us.
My pleasure. Thank you.
Liz Ann Sonders is the Chief Investment Strategist at Charles Schwab. Thanks again.